What's going on, guys? Yeah, I can't imagine what this. Good morning, good morning, good morning. What's up, guys? How y'all doing? All right, y'all ready for today? All right. For those that don't know, we're gonna have, I believe it's no, yeah, we're gonna have job report numbers coming out today at 8:30. So just a quick recap, right? Because yesterday we had FOMC meeting minutes, and pretty much the markets took it more hawkish than expected, probably more hawkish than the actual rate decision. So when it comes to this data today, we need, in order for us to get a dovish outlook, right? We need to get a certain data print that's going to confirm they're going to be looking for rate cuts, because as of right now, we could see the division in the central banks, right? We have them, certain central bank members are liking the expectations of lower inflation and want rate cuts. Majority of them are wanting to be data dependent and keep rates the same. So the fact that they want to keep rates the same, right? This is why we've been seeing a stronger dollar. Okay. Equities did push higher yesterday because we had strong Nvidia earnings. So that did support the stock market. So now the focus today is going to be on these job numbers. In order for us to see a change in the Feds, right? For especially for December, we need to see a completely bad print today. Like, we have to see a complete miss, because remember, they're already expecting a lower print, right? They're expecting low growth. They're already expecting a little bit of deceleration of inflation. They're expecting unemployment to tick up a bit, but they're not expecting recession, right? Like a horrible print. So that's not what they're expecting. If we get somewhat of a lower print today, it may not be significant enough to see like a massive drop in the dollar, right? We probably won't see anything significantly that way unless we get inflation data. Okay. So we just have to be a little cautious today, because the Fed's kind of made up their mind. It'll be great, whatever print that we get today, then we listen to Fed speakers afterwards to kind of confirm it. That's what we're going to have to really pay attention to. All right. So when it comes to non-farm payrolls, right, it'll be great to get a massive miss. But I think if we could get anything below 50, because previous was a 22, right? So we're already seeing like job data is contractionary. We could see that is lower than expected. But if we need a surprise, I would definitely want to see it below 22. Negative 20 might be a stretch, but you never know. But if we do get something extremely bad, at least below a 22, to at least spark some fears, right? If it comes out as a 50, like overall, it's bad, but we want to see a weaker print. That's what we want to see. And then along with unemployment, at least going to 4.4 or 4.5, above a 4.5, very bad. Right. But if we could get a 4.4, at least the trend of unemployment is going up. At least we could see that the markets is seeing, we are seeing job loss. And lately we've been seeing a lot of businesses is doing layoffs. We've been seeing that lately. So that shouldn't be a surprise neither. All right. But now, one sec, guys. All right. So now when it comes to earnings, right, we want to see earnings coming lower because that's inflationary. All right. So we want to see earnings lower, unemployment, non-farm payroll lower, unemployment higher. That is a complete miss. That shows that labor data is bad, plus with lower inflation. If we get that type of print today, we will be expecting weaker dollar, most likely stronger equities. I would explain equities afterwards for you guys that just trade NASDAQ and US 30, but that's a dovish reaction. Now, if we want a hawkish reaction, meaning that if data comes out stronger than expected, we're going to be expecting most likely the Feds to want to pause interest rates, right? So what we need to see for that is like data staying the same, right? Most likely if it's as expected, or if we see that unemployment is actually lower, it goes to a 4.2 or anything below that. If we see non-farm payroll stay above 50K, right? If we could see like non-farm payroll is above 50,000, most likely, you never know. I don't think it's going to hit 120K, but if we hit 120K, hawkish reaction. Then we need to see earnings a little higher too. If we can see earnings like at a 3.8, right? That shows that it's higher inflation. We got strong job numbers. That would give all the reasons for the Feds to remain data dependent. Okay, guys? So that's what's going to be important moving forward for this print. So you could just look here. This is like the bank expectations, right? So this is the median of where they expect non-farm payroll to go, right? So we already know 50,000 is the forecast. So that's the median. So a surprise, it's going to be an outlier. So this is why they have 120K jobs being like job numbers going good for that to be the outlier. That's only one bank that's expecting that. And you can see the low is one bank expecting like negative 19K. So if we could get anything below, I would say if the job numbers today is below 30,000, that would probably be a surprise. Okay. To the upside, I would say if anything is above 50, it should be okay, like above 50. But if we want to miss, right, where it could actually shift the odds of the Feds cutting, I would definitely say below 30,000 would probably be something significant. Okay. So that is what we'll focus on with that. Unemployment, this is where you can see they're pretty much all expecting a 4.3. So we already know the numbers with that. Now, when it comes to like the monthly earnings, we got one outlier of 0.4. So a 0.4 or 0.5 should be high enough inflation. But if we want anything lower, a 0.1 would be an outlier. Okay, that would be a surprise print. Now, when it comes to the yearly, we already went through this also. A 3.7 is the median, is the forecast. So a 3.8 would be higher inflation. It'll be very inflationary. And deflationary, I would say like a 3.5. We only got one bank that a 3.4. But if we get a 3.5 or a 3.3, that would definitely be deflationary. Okay. So that goes with the numbers. So far makes sense, guys. Put a 1 if that makes sense. Everybody's clear. You know what we should be expecting from a weaker print and a stronger print. All right, cool. Yeah, exactly, Brian. I'm not expecting. That's why we need a surprise for this one, Brian. Exactly. So Brian's question, but isn't layoffs only starting very recently, but the job data is for September? Yes. So that's why it has to be a surprise. It has to be something like extremely bad in order for the markets to really care, from my opinion. It has to be something significantly bad, like in order for the markets to care. Try to make it easier for you guys to see. Pump and dump program, yeah. Yeah, so yeah, it has to be something crazy today in order for the markets to really care. You know, my opinion, it has to be some crazy shit today in order to, especially for a cut, like to get those expectations. It has to be like the number has to be so bad where we're like, oh shit. You know, like it has to be something like that. Other than that, you know, we could expect some minor moves depending on the print. But if it's not anything significant, probably won't be anything worthwhile because, the data is old news. So I'm not expecting I don't expect this print to really change their expectations, you know, so it has to be something significant. But it's something that we could watch, right? Because finally, like we're going to finally get some economic data, all right? like finally. All right, just could start off with equities because I know a lot of you guys trade equities. So when it comes to equities for this print, this is what has to be. You have to be a little more cautious from this. I think it's like September, if I'm not mistaken. It's not last month. It's the month before that. So when it comes to equities, we have to be, September. Thank you, Leo. Yeah, so we have to be cautious when it comes to equities with this print, right? Because I could see equities being like whipsaw price action with this one. Yeah, October is not going to be released. Yeah, so this is September's. So interesting that they're not releasing October's because we've been seeing the massive layoffs. I wonder, that's the reason why. You know what I'm saying? Because they don't want us to get that, oh shit, the economy is worse than what we thought approach, right? They probably don't want us to feel that way yet. Because especially the feds don't want to cut rates, right? They probably want to wait until next year. So it helps their job to not release the data. You know what I'm saying? So it'd be interesting. Like, it feels like they're hiding something from us. Yeah, exactly. Because why not release it? You can't just say, oh, well, nobody was at work. Like, bullshit. So that, it's bullshit, but it'd be pretty interesting, when the truth actually comes out. Like, we'll know. We'll definitely know. But they'll definitely hide it from us. They'll definitely hide it, so people won't recognize it, but probably numbers is way worse than expected. But yeah, when it comes to equities for this print, it could be whipsaw price action, meaning that if we get a higher print or a lower print, we could see up and down price action. So you have to be cautious with that. But if the data is lower than expected, right, this is for hawkish and dovish scenarios. So if we do get a lower print, right, very low, expectations could be there for a rate cut, which could also support the stock market to push higher, right? With that going on, dollar is going to go lower because of a weaker print. That would involve more rate cuts. Gold will push higher. We already got gold breaking structure here. I am pretty sure some of you are in buys already, but a weaker print would cause these directions to hold, especially GU breaking above structure. EU is going to break above structure with a weaker print. All right. So, and when we're looking at, I look at USD JPY is a good pair too, because we get that the yields, the dollar and the yields is going to follow. And usually that also makes the yen do the opposite. So if we get a weaker print, that's going to cause USD JPY to push lower. Okay. So that could be a good option as well. If we get a stronger print, that would be a hawkish reaction. So for the stock market, right, that would increase the odds of a pause, which is already there, but this would kind of like confirm it. We could see equities push lower if we get a higher print. And that is going to help dollar continue to push higher. And this will push gold lower, okay, because of stronger dollar and stronger yields. USD JPY will push up higher because of a stronger dollar. Then we'll see weakness in GU and EU breaking below support. Okay, so this is the reactions. Dollar should follow the data. All right. But when it comes to equities, we have to see the type of print that we actually get. All right. Because that's what's going to matter the most is the type of print. If the print is like extremely bad, that could cause a recessionary reaction. So we could see a risk off market. We could see equities push lower. AUD, NZD, CAD get weaker. We could see the yen gain strength and the Swiss could gain strength, right? The dollar could also gain strength too if it's a risk off market. That's what we have to be cautious about. But I would expect the dollar to follow the data, but the stock market might follow risk sentiment. So if we get like a very, very bad print, we could see equities spike up higher, expecting a pause. We could see a very bad print, right? We could see equity spike higher, expecting a cut, and then just melt right after that, because that's just confirming shit is worse than what we thought. Okay. So that's what you have to be aware of. Like when it comes to a beat, right? That's good for the stock market, good job numbers, good growth, right? We could see the stock market rise off of a good print, and then it could drop with the expectations of a pause, right? Moving forward, making the Federal Reserve stay data dependent and patient. So you guys could see the the possibilities when it comes to equities, right? So that's why it's going to be double-sided, because first, this is old data, right? 2 months ago, last month, and then 2 months ago, and then we don't have upcoming data, and plus the Feds are already divided, and they are already expecting to pause rates in December. So we have a bunch of what ifs. So this data is not, if it's not something significant, we can't really guarantee like a true direction. All right. So that's the problem. So just to make sense. All right, guys. So for this print, I like Euro USD, probably focus on that. But everything should be good. Like whatever you pick should be pretty good depending on the print. Like equities, just be cautious. Wait for a break of structure. If what we stay away from is if the data is mixed, right? We stay away from that. We don't trade mixed data. So if it's mixed, leave it alone. There's no clear edge, leave it alone. All right. All right, makes sense, guys? Put a 1 in the chat if it makes sense. Yeah, I don't want to see mixed data neither. That should be insane. Intervention, yeah, like Rob, is a good question. Like he's saying if JPY pushes higher, should it be risk for the Bank of Japan to intervene? Like, yeah, like we're at levels where we should be worried about it, So yeah, that's why I'm leaning more towards EU instead of the JPY pairs, because they could do intervention at any time. We're not going to know when they're going to do it. If we get a higher print, it's just a higher probability that it might happen. Ray Dario, we're at 80% into a bubble. He been saying, they all be saying that. But if it's a possibility, that's why I probably don't want to. If it's a miss, it'll be a great sell, right? But if it's a beat, it's like you got to be cautious of that, just in case. Like, I don't think it will be like soon as the data comes out higher, like UJ will push up and then they're just going to intervention and then the shit just going to, I hope is nothing like that, because that shit is going to be crazy. But most likely if it's a beat, then be on the lookout for the Bank of Japan to put out comments on like, oh, we're watching the FX markets and stuff. Like, just be prepared for those type of comments, definitely. But I'm not going to say, would it happen? Yeah, we should always be worried about that. Do we have Philly Fed? I don't think that shit is. I know the markets are just going to focus on, we're just going to focus on job numbers. I don't think they're going to care about everything else. Yeah, and it might be very volatile. It's the first print that we have, man, since the shutdown. So, yeah, just be prepared, man. The shit probably get crazy. Yeah, so equities, just be cautious. All right, just be cautious. Do you set buy and sell limits, or I just enter when I see a break of structure. First see what the print is and then just enter in a break of structure. Yeah. Yeah, people try to it's tough, because we understand that this data is old, right? So that's one of the problems. When you're trading equities, this could be double-sided. So I would just say be cautious. Hopefully, like the first opportunity is if we get a complete miss, like it has to be complete, like a no brainer missed opportunity. Like that's a no brainer. That's what we want, right? If it's just somewhat stronger, that's just going to increase the odds of a pause, right? So that really just doesn't matter. Stronger dollar, right? Probably see equities go weaker from that, but just be cautious, right? In order for the markets to shift expectations and start fully pricing in a cut for December, we need to really see a surprise, like a surprise miss across the board. So that would be, if it's just like, if we just see red data and there's no surprise symbols, like expect the red arrows to follow, but still be cautious because it might not be that aggressive. Okay. So that's the problem with this print, is that it probably won't be that aggressive. That's why, like, it's best to, because it's old data, right? Because we already see the new layoffs now. So if we get we get a beat, why would the markets really react to it if we already see massive layoffs, right? So it's tough. Yeah, it's gonna be interesting for this one. So we watch it together. You enter impulsively if it's below. Yeah, if it's below, like if we see a massive miss across the board, yeah, like no brainer, guys. Yeah, crazy day for NFP. Yeah, man, this is crazy. Yeah, hopefully it's like no freaking delay and shit like that too. You know what I'm saying? Like we got other stuff to worry about as well. All right, 10 seconds, guys. All right, 5, 4, 3, 2, 1. Let's see what we get. Non-farm came out strong. Like, yeah, this is mixed, but because you see unemployment did come out higher, more job layoffs, that we see non-farm payroll actually did pretty well, very close to the high. So this is mixed, okay? Very mixed. But earnings, the monthly is lower, but the yearly earnings, which is more of the focus, is inflationary. So we got a mixed print. So like, does this really change anything? Probably not. It shows strong growth, right? But we see an increase in unemployment. Like this could be inflationary. I feel like if I look at this print and I'm a Fed member, I wouldn't be rushing to cut interest rates, right? But is this tradable? This is not really tradable. You get what I'm saying? So whatever volume that we get, like we got a mixed print. So whatever volume we get right now might not be worth it, right? Because even jobless claims came out good. So we had like jobless claims, like it's funny because initial jobless claims came out strong, but unemployment was bad. Like what the fuck? Yeah, like, so that's crazy. And then the monthly wages, right? Earnings came out lower. The yearly is higher. So payrolls is actually higher, and then non-farm payroll is higher. So it's like, yeah, it's crazy mixed. So yeah, I'm gonna send a screenshot and put it in the Discord, guys. Yeah, I didn't enter nothing. Yeah, we're gonna get volume because it's just like algorithms is going crazy right now. The VIX is down, so it's helping equity. Yeah, like non-farm payroll going higher, guys. This is good for the stock market. I'm not like, even though that this supports a cut, I mean, yeah, this supports a pause. This is still good for the stock market, but it's mixed, right? So if you're taking a trade, you're just following momentum. But to me, this is good for the stock market. But I didn't enter nothing. Yeah, to me, it's not worth it. Yeah, so you guys could use that for your notes. But yeah, it's pretty, yeah, like damn. Yeah, dollars is back into the range. So dollar pushed lower. Like now the story is on the yields, right? Because if the yields continue to push down, that's what's going to help the dollar push down. So that's just really it. But I'm not in anything. Yeah, like, so we're seeing a dovish reaction. So you see that the red arrows is pushing lower, equities is pushing higher. So the data did come out mixed. But yeah, like because unemployment, that's the only thing. Unemployment is at 4.4. So I don't like, if I would have saw a hawkish reaction, like stronger dollar, I would have liked that better. But like to see a dovish reaction, this doesn't show me that they should. Yeah, exactly. It supports strong growth, but this doesn't support a decision for a Fed. You know what I'm saying? Why is it good for the stocks? Because we got strong growth. Because we got strong, like the unemployment, non-farm payrolls is at a 119. The high was a 120. Previous was a -4. It just got revised. So it was a -4 was the previous. So we got 119. So that's a big jump, so it's a really big jump. Yeah, so the revised, all right, I could see that the average earnings monthly was revised. So the previous was revised, 0.4. So I could look at that being more, yeah, I don't like the dovish reaction. I don't think nothing really supports this immediate reaction, to tell you the truth. Private payrolls had a big jump. Yeah, I don't like this reaction. Like continuous jobless claims came out worse. Initial jobless claims came out good. So that's mixed, and then, yeah, it's just a mixed print. It's nothing really to try to dissect it. It's not really worth a trade. Like, I'm going to just be patient. It's just a mixed print. So I don't think it's really worth it. No, like, I mean, it's just in a range. It's not really like dropping. What time frames y'all guys be looking at? Like, damn. Yeah, traders add bets on the Fed's rate cut. Latest economic data, still the Feds. Still see the Feds. Yeah. I think it's like we can look at the CME report. I don't think this supports a cut. This still makes them data dependent, and plus it doesn't really matter because it's old data, and we already been seeing the massive layoffs, right? We've been seeing it already. So that, to me, that's what's more important, is the massive layoffs. Yeah, 60%. Yeah, and it gets updated too. So you can watch it for the next 30 minutes. So now after this print, now it's going to be important to get Fed speakers' comments to see what they expect. Yeah, they love the 1 minute. Yeah, like you're looking at my screen and it's like, I show a box to show the range and they're like, it's melting. I'm like, man, I don't see that. Yeah, you got to change the way you look at the markets, brother, because yeah, it's a bad sign. Like everything is impulsive to you, and that's an issue too. Like if everything's impulsive, yeah, like because if you look at the markets that way, like that's why you have FOMO, you enter in trades. It'd be like a 20 pip move, and you're acting like it was 1,000 pip move. So you have to zoom out. Yeah, Trump's gonna be pissed. All right, so you see no change jumped up. You said that it was 60%, so yeah, it jumped up to 70. So the no change, yeah, that's why I like that drop in the dollar. Just it didn't make sense. So at least you can see I'm on the right track, right? The data doesn't support a cut, so that's why that immediate drop in the dollar that really didn't make sense to me. But hey, it could do what it wants. It doesn't mean I'm gonna chase those sells, but yeah, I'm gonna stay out of this one. I'm gonna stay out of this one. But like, yeah, I'm gonna post it. I'm gonna post the CME just in case if it moves again, and I'll update you guys on it later. All right, so far, with the data came out mixed. Strong NFP numbers, what came out really good. So they're gonna probably talk about that on the news a lot. Just the NFP is good. Like that's what they're gonna just blaster on the news headlines. But this doesn't really support a cut. So seeing like the yields in the dollar drop in the way that it is right now, to me, it just really, I don't expect this to also cause dollar to rise neither. I don't want to get you guys confused, but this could cause like indecision, mixed price action. We are right now, like we're seeing a dovish reaction and the markets is expecting a pause, but we're seeing the like price action is supporting a dovish reaction. So I don't personally like it, but now it's up to you guys to take what y'all want. I would personally say just wait until, if you're taking it now, like if you took the gold buys at the break of structure, right, or EU and GU, just be cautious. We want to see dollar hold below 101.050. And then also remember NYSE is at 9:30. Okay, so just be prepared for that as well. Let me just see the Fed speakers that we have today. And some might just be not scheduled, so they might come out afterwards too. Today's Thursday, so we have so 8:50. Yeah, Cook, like usually Cook and Goldsby is good. Like Goldsby, Cook, we probably have some more. Let me just put this in. I think we would probably get some more Fed speakers to come out. Probably would get. I think Trump would come out too. I don't think his comments is going to matter as much, but we're going to get a few. We're going to get a few speakers coming out. We definitely would. Yeah, but yeah, guys. I'm pretty sure some of you took the gold buys. I'm pretty sure somebody took US 30 buys. It broke structure. Like if you taking it, it's just more. You're just following volume pretty much. But personally, me, I'm not really taking anything. Like it just doesn't make sense to me. Anybody took a trade or y'all being patient? Yeah, I'm not comfortable with it. Yeah, good job. Yeah, there's no right or wrong answer. But me, I'd rather just wait. I prefer if you guys just wait until like after 9:30. Yeah, like NASDAQ is good because we had good earnings yesterday. So we probably could see a recovery in NASDAQ too, especially with this NFP print. This, to me, like today should be good for equities. It should be good for equities. So now when you're looking at the VIX, so remember what I was telling you guys, right? With the VIX, where we like this whole week, it was literally it was at uncertainty territory. So now that if it starts coming below 20, right? You want to see it go below 20, and I think that will be a good catalyst that we could probably see equities continue to push higher. So if we see that the VIX starts breaking above 22, heading to 24, then expect those sells to come in place. But we want to see the VIX at least go below like 2019. That would be a good idea to see those buys happen, all right, for equities. But just wait until like after 9:30, all right, guys? But so far, like I like the idea of equity buys. Dollar, probably be a little more cautious with dollar. Gold breaking above structure. I think gold is just doing the opposite of dollar in the yields. So that's why gold is spiking up. But I'll probably be cautious. So wait until after 9:30, see if we get a clear direction. You was already in buys at 40.67. Yeah, good job, dude.